Well, stocks ended last week almost exactly where they started it, with the dollar doing pretty much the same thing, although that does mark a decent level of choppiness and intraday volatility that we saw throughout the last 5 trading days or so, with markets digesting the end of the US government shutdown and participants starting to brace for a bit of a data deluge this week. That data deluge gets underway on Thursday, not Friday, as I've written on the screen here, with the September US labour market report. And although that data is stale, it will nonetheless be key in shaping expectations for the final Fed meeting of the year. Focus also falls on a busy UK data docket, including the latest inflation and public borrowing figures in the run-up to the budget next Wednesday. Plus, of course, we have an absolutely huge earnings release due from Nvidia after the close on Wednesday. As a result, plenty for us to discuss on the trade-off this week. Without further ado, let's crack on with the show. So the US government has reopened. The data vacuum is coming to an end. Of course, we never shut down here on the trade-off. And joining me, as always, is my good friend Ryan Littlestone from Forex Slow Live and Forex Analytics. Ryan, a very good afternoon to you, mate.
Good afternoon to you, Michael. And yeah, we're back with the data. Though I was commenting in our chat room last week, I was starting to enjoy the lack of data, just giving us a bit of peace and quiet. Don't have to worry about things every day and what the US is up to. And I was getting used to it. And now that's all been spoilt by them bringing it all back again.
Indeed, and you had to use that horrible, dreaded Q word in your introduction there just to tempt fate. And we've got, 4 or 5 proper trading weeks of the year left to go. And it does feel like it could be a little bit of a bumpy ride, at least given what we had last week.
Yeah, well, we have got 4 or 5 weeks. Judging by your calendar, you've got about 2 days left before you pack up for the year.
Well, I have long since argued that Thanksgiving is going to be the effective year end in 2025. And if that's true, happy last proper trading week of the year, everyone.
Yeah. Meanwhile, the rest of us will be here, nose to the grindstone as always.
Yes, indeed. You lot do that while I go and enjoy a few Christmas lunches around the city. In any case, there are some important matters to attend to before we do that. So let's get on with Topical Thunder. I think, ladies and gents, that just comes from a place of jealousy because Ryan doesn't work in the city anymore. He doesn't get invited out. He just misses the good old days. But there we go. Anyway, speaking of jobs, we do have the latest US labour market report due this week. Now, I say latest. This data is September data. It is, of course, very stale, but it is, and it's 7 weeks late, but it is the first official data that we've had on the US labour market since, the August jobs report at the start of last month. So there's every chance that it could still be a decent market mover. In terms of consensus expectations, headline payrolls are seen having risen by 50,000. That would be about double the pace that we saw in August. And of course, we've got a lot more leading indicators for that number than we would usually have, given that we're 7 weeks down the track from when the data was meant to come out. The ISM manufacturing employment metric, that was its highest level since May. The ISM services employment metric, that was its highest level since June. We also saw a decent fall in both initial and continuing jobless claims between the August and September survey weeks as well. The one potential negative factor to keep an eye on is whether we see the impact of any of those Doge-related layoffs, those deferred resignations, although given the timing of the reference week, that's probably going to be in the October report, if we get it, as opposed to being in the report that we'll get this Thursday, not Friday. The data is out on Thursday. In terms of other parts of the report, average hourly earnings expected to have risen by 0.3% on the month. That would in turn keep the annual pace unchanged at 3.7% year on year. Unemployment, meanwhile, that's seen having held steady at 4.3%, which would also be unchanged from where we were in August and equal to a cycle high. Although the bar for us to round up, and I know Ryan loves this little stat I throw in, the bar for us to round up to 4.4% is not an especially high one, given that the unrounded unemployment rate last time out was 4.324%. Now, in terms of context, the jobs report, the September data, comes with just under 4 weeks to go until the next FOMC meeting and the final meeting of the year. The money markets, of course, have undergone a pretty significant hawkish repricing in the last couple of weeks, with futures, as I speak, now pricing just a 40% chance that the Fed deliver another 25 basis point cut at that final meeting of the year. As a result of that, I would argue that risks around the jobs number probably tilt in a dovish direction. I think it's a relatively high bar to expect the market to go further in terms of its hawkish repricing from here. I think not only if you look at the mathematics on the FOMC, but also what the Board of Governors have been saying, the path of least regret still seems to be trending towards further rate reductions. And of course, if we do get a soft jobs report, even though this is September data and it is a little bit out of date, that would obviously be more likely to push the Fed in that direction. Do note that we are potentially going to get the October and the November jobs reports before the next FOMC meeting, although we are still waiting for the BLS to confirm that the exact release dates for those reports. I guess the bigger question from a market perspective, at least in terms of risk sentiment, is does the market look at this as a case of good news being good news, the economy doing all right, the labour market ticking over, but potentially that leading to a tighter policy backdrop, or does that potentially tighter policy backdrop actually act as a headwind? Of course, the jobs report comes about 18 hours after those Nvidia earnings, which I would argue are going to have a much bigger role to play in terms of driving sentiment this week. But nonetheless, I would still be viewing dips as buying opportunities for the time being. And I guess the question is, Ryan, the jobs data is back. Is the Forex Analytics sweepstake back?
I don't know. I'll have to let you know later in the week about that. See if I can get it out in time. What's going on?
Organise your brown envelopes and your briefcases.
Oh, here we go. The sour grapes. 8 months later, he's still banging on about it.
It was actually about 8 months, I think.
Yeah, probably is. I've lost count. You haven't, obviously. But anyway, yes, back to the important things. And yeah, this data is going to be important, as you say. It's the first data we're getting since the shutdown. It's the NFP data, the biggest data point of the month. You can look at this in two aspects. One, this September data. Has it justified the market's pricing? Has it justified what the Fed told us at the October FOMC? And thus how it's going to impact this December meeting. Now, this December meeting is a 50-50 choice at the moment between them cutting again and staying on hold. And I think there's a lot of room because of that to see some very hefty price moves if this data goes one way or another. Powell himself, pulled the rope a bit more into the middle at the last FOMC. We expecting 2 cuts, maybe 3 for the rest of the year. And he was just, December's not a foregone conclusion. So just pulling the market back a little bit. So this data is going to affect that. And then obviously subsequent data is going to add or take away from it. So it's going to be very important either way. I think we're going to see some big volatility around this number. So you need to be careful. You mentioned about the Doge jobs. Yes, some of them may fall in. We can't assume that all those contracts ended on the same day of September. They could have been spread out across the month. We might see some, we might not. We might see more than we expect. So it's important when we look at the NFP number is to look at the components. Remember that the headline NFP is the net number or the compiled number from private, government and manufacturing jobs. So look at the breakdown. If we get a number and it's all about government jobs, then that's going to change the perspective, if it's a good number or a bad number. If it's down 100,000, but 400,000 of those were government jobs, then you could say, well, private payrolls were perhaps up 100,000. That's a positive. So it's going to take a bit of nuance on this data to get a real read from it. But it's going to be very important. And one thing I'd say look for is the 10-year yields. We're really stuck in this range. We've been speaking about this for quite some time, as you can see from the chart, in between this sort of 3.90, 4% and the 4.20 level. Where this goes after that data is going to indicate where the dollar's going and where potentially the market's going to be repricing about the Fed. So if you have one chart open this week through this data, make sure it's that 10-year yield.
Yeah, absolutely. Fully agree with that one. And I think it is definitely going to be a case of the devil is in the detail of the report, not only in terms of the composition of hiring. The other thing to bear in mind on that front is pretty much all of the jobs the US economy has added this year have been in the healthcare sector. Basically, the only reason the economy's been creating jobs is because the population's getting older. So that's another thing to keep an eye on. And of course, the revisions as well, the 2-month net revision. Again, it sounds ridiculous that I'm sat here in November saying the revision to July data matters, but given how those revisions have trended lower in recent months, that's going to be very important. And also there's the potential for a decent revision to the August print as well. Actually, it shows how much time we've had on our hands with no data. If you look at the survey response rate in August, it was actually the lowest level in 25 years, which gives you potential as more responses have come in for that data to be revised in a more significant manner. But thankfully, we don't have as much time on our hands anymore, because not only do we have NFP this week, but a whole host of other economic data as well.
Yeah, it's a busy old week, because aside from that NFP data, we do have a ton of important data as well. We've got US manufacturing kicking off in November. We've just had out the Empire manufacturing report that came in a healthy 18.7 versus 5.8 expected. So a decent number there. The components were a little bit mixed. Employment was pretty flat. Prices paid came down a little bit, as did prices received. That's followed by the Philly Fed on Thursday, around about the same time as we get NFP. So that'll probably get a very secondary look on that. And then on Friday, we start getting the flash PMIs, which we get from around the globe, but we get them in the US as well. Now, I'm not sure if we're going to get initial jobless claims on Thursday as either. I don't know if you confirm that, but it might be in the cards.
My gut feeling is we probably won't, because the BLS would have been shut last week and wouldn't have compiled it. But don't quote me on that.
Yeah, isn't it the Labour Department that does that one?
Yeah, I think that I would wager we probably start getting that from next week onwards. Yeah. But again, we're still sort of waiting for confirmation on a lot of this.
Yeah, so we couldn't get that one. As I say, depends on whether they can compile it in time, and as with the NFP, how they'll deliver it, whether we'll get all the numbers or not. Anyway, those PMIs will be dropping from around the globe. We get Australia, Japan kicking off first of all. Also on Thursday, we get Japan's national CPI data. So that's going to be an important watch for the Bank of Japan. And then, as I said, the European PMIs follow on Friday. Now, the UK has two important data points this week. On Wednesday, we get inflation hitting the streets. And while that's obviously going to be important for what the Bank of England do, it's also likely to be political football used by Reeves, whether it's gone up or down towards what happens in the budget, because we know politicians like to claim they can tame inflation, and when it moves their way, they can claim credit for it. We know that's a load of something that I won't swear, obviously. It comes out the rear end of horses. I'll leave it there. And CPI is expected to drop. Headline CPI is expected to drop to 3.6% from 3.8% year on year, and the core is expected down a point to 3.4 from 3.5. So softer inflation we're looking at from the Bank of England, and that might, as Michael alluded to earlier, get the Bank of England thinking about those rate cuts again. UK retail sales hit on Friday, and we're expecting another gain is forecast, 0.1%, just a small one, but that will mark
the champagne out. Let's go.
Champagne. Well, you say that, but that would mark the fifth run of positive numbers in a row, and we haven't seen that since we came out of the first lockdown in COVID. So it would be significantly positive if retail sales, I expected them to fall off a cliff in September, and they didn't. So maybe this is the one. But yeah, it's a good UK consumer sort of, throws it out the window what we're seeing in the rest of the economy, particularly with jobs. So maybe this is just a ticking time bomb that's going to happen. Anyway, we get that on Friday. I'm knackered now. Plenty to keep us entertained this week. And obviously markets will use this data to price and reprice all those central bank expectations. So, it's going to be a busy one.
It is indeed. And yes, I did allude to the Bank of England earlier on, but it was off camera, so no one's got any clue what you're on about at this point. My point was that if headline CPI, basically all we need to do is just come in either in line with or below the BOE's forecast, which is 3.6% for October, 3.4% for November. And if we do that, then a rate cut in December is pretty much locked in at this point. The other thing that we get out of the UK this week is the latest public borrowing data. That's also due on Friday at the same time the retail sales print. And of course, that comes ahead of the budget next week, which I'll get onto momentarily. But yeah, you're absolutely right. A lot of data out this week. I think the US figures, everything's going to play sort of second fiddle to that payrolls number, even though it is somewhat delayed at this point. We also get the weekly ADP estimate that's due tomorrow, if we can even think that it's worth the paper that it's written on. And yeah, PMIs out of the Eurozone are going to be pivotal. Of course, I'd be expecting that the ECB's cycle is done and dusted at this point. And then that Japanese CPI, I know you're going to talk about the yen a little bit later on, but the BOJ seem in absolutely no rush to do anything whatsoever. So we'll see whether that CPI data can potentially force their hand a little bit for that December meeting.
Yeah, absolutely. And yeah, are you going to be here for any of it? That's my next question, really.
Yes, unfortunately, I will be here. I don't actually have any lunches booked this week.
No.
Should we schedule a little slot in the show? Mike Brown's diary, and just go through day by day to see how hard I'm working over here.
Yeah, that probably lasts longer than the show, going through your lunch.
It probably would. Right, let's move on to something else that we could string out for the rest of the show, which is the UK budget. I'm going to be completely honest with you. I am as sick of talking about this as you are of hearing about this, to be completely honest with you, dear viewers. But with just 9 days to go until Budget Day on the 26th of November, 8 by the time you watch this video, we seem to be descending ever further into utter shambles, if that was even possible. Of course, for a number of weeks now, market participants and the general population alike have been braced for an income tax hike in the budget, potentially as much as 2 pence in the pound on the basic rate. However, reports broke late last week on Thursday night via the Financial Times that actually Rachel Reeves doesn't want to do that anymore. For whatever reason, there was a bit of damage control going on Friday morning where it became clear that the Chancellor has scrapped the idea of raising income tax, not for any political considerations, but after receiving a better than expected forecast update from the OBR. Now, there's two issues with this. The first is that the OBR have basically been wrong about everything they've ever looked at and everything they've ever forecast since the damn thing came into being all the way back in the early 2010s. But the second is that this really just sums up how reflexive the whole sort of fiscal doom loop is here in the UK, because the reason the OBR's forecasts were better than expected was because of this sizable rally that we saw in gilt yields over the month of October when the OBR were taking their forecast snapshot. The 10-year gilt went from about 4.7% all the way down to about 4.4% during this forecast window. And the reason why the market rallied so significantly and why the spread on gilts over G7 peers narrowed so substantially is because the market had sort of coalesced around the idea that although an income tax hike obviously does have significant drawbacks, it was the best of a load of very, very bad options. And at least it's a guaranteed revenue raiser that would mean there is some degree of fiscal consolidation in the budget. Now that Rachel Reeves has pulled a U-turn on that, gilt market participants have gone, well, hang on a minute, we need to pull a U-turn of our own. We've seen the 10-year gilt yield rebound to a 1-month high, basically undoing all the work that's been done there. And also, of course, in the next OBR forecast update, which comes on Friday, what do you think is going to happen? Well, the black hole's going to be even bigger because gilt yields are now higher. Frankly, this is all an utterly ridiculous situation. We are about a week and a half away from the big day itself, and it would appear that the Chancellor has essentially ripped up the majority of the budget and is now starting from scratch again, although of course the one thing she can't do is U-turn again and say, actually, I've changed my mind for a second time. We are going to raise income tax. I fooled you once. Now I'll fool you again. You would lose all political credibility if she did that. So what we now seem to be doing is going towards a budget that's going to be packed full of kind of piecemeal tax hikes, a number, very big number at that, of smaller measures that are going to raise a couple of billion quid here and there, but which in the market's mind is not particularly credible because there is no guarantee that these smaller measures are going to raise anywhere near the revenue that's required in order to plug this fiscal deficit. We know that the government is either unable or unwilling to cut spending. So market participants are sat there going, well, the logical conclusion is that there's a much higher probability that you're going to have to borrow much more than you'd previously we've been expecting. Frankly, it is a complete and utter mess, and I think it's very, very hard to say anything other than risks tilt firmly to the downside for the pound, for gilts, and probably for Rachel Reeves' career as Chancellor as we move towards the 26th of November and certainly after it as well.
Yeah. Oof. Where do I start with this without having a same-sized rant you've just gone through?
I thought that was relatively calm, actually.
Yes, it was. It was very restrained. Now, I've got a couple of points. Firstly, this is how most budgets follow. Although this one's been, a massively magnified deal. They always float out what we call the trial balloons. They drop their potential measures that they're going to take in the budget, see how it goes down in the press, see how it goes down in the public, see how it goes down in markets, and then they tinker around. Oh, that one's too much, so we'll rein that one in a bit. But this one with the OBR and the forecasts, I can't understand, because Rees apparently would have been getting updates all through the last month or so from the OBR. It's not that they just produce one report and go, there you go, that's it, work your budget off of that. These numbers are adjusted all the way through. I know they've got to take a snapshot at one particular time, but she would have known what's been going on day to day, week to week. So how she can go in and out, emergency press conferences and all that sort of stuff is beyond me. Secondly, yes, we know the OBR, call them the Office of Bodged Responsibility. They couldn't forecast the next hour on a clock, let alone what the country is going to do. But and this is where I've got a bit of sympathy for Reeves, because you can't.
Whoa.
Yeah, I'm glad you're sitting down. She can't manage fiscal policy just on every gilt move. If yields bounce 20 pips, that sucks into a black hole. Well, that's not how you can run a country. That's one of the questions I wanted to ask you. I know you're talking about the 10-year gilts, but I've got the chart here of the 30-year gilts. Yes, we've seen a bit of a rally in yields, but we're not back up to those highs that we saw earlier this year when things were really looking grim. So, yes, it might have eaten into some of her headroom space, but the gilt market for me isn't signalling that we're up at those pressure points that we were at earlier this year. And I think she's going to take some solace for that, or from that. My question to you, Michael, is, with this bounce we've seen in yields, is this just sort of a bit of mechanical repricing rather than indicating that the market is really, or investors are really unhappy with what's coming?
Yeah, potentially. I think your broader point around, we can't be, well, as Andy Burnham said, in hock with the bond market is correct. The reason we are is because as a country, we're spending beyond our means, and we've got a chancellor that doesn't have any credibility with the market. If we hadn't maxed out the proverbial credit card and we had reined in spending in the summer, particularly on welfare, then, you probably wouldn't be worried about the next 20 bips in the 10 or the 30-year gilt yield. But because you didn't, we are. As for where, it's not a particularly difficult concept in my mind. As for where markets currently trade, I think you're right. I think we are sort of not quite at panic stations just yet. I think there's a few things helping that. Of course, we've seen government debt rally across the globe. We've also had that dovish, and I know this is going to impact the front end more, but that dovish hold from the BOE in November, opening the door to a cut in December next month. Inflation is also on its way down, and it's very, very unlikely that the budget is going to be as inflationary, if at all, as it was this time last year. But I do think there's probably two considerations here, and I wrote a note about this last week if anyone does want to read it. The first is for gilt operators, and the pound actually. The first consideration is the fiscal side of things. Does the budget balance the books? Is there a credible plan to fix the foundations, or whatever political slogan you want to slap on there? Is there fiscal headroom against the rules? What do the OBR say? The second point that I think markets are potentially already trading on, even though we haven't actually had the budget yet, is how does this go down politically? Now, what I mean by that is it's fine. Rachel Reeves may be able to balance the books on paper, but if the policies she enacts in the budget are so unpopular that Labour MPs or even the electorate at large sort of are up in arms in terms of reaction, then her days as Chancellor will be numbered, and by extension, Keir Starmer's days as Prime Minister will probably be numbered as well. And we know, I think market participants are very much of the view that, it's better the devil you know with Rachel Reeves. Nobody in the square mile will be saying you are sort of our dream choice for Chancellor. but you are the choice for Chancellor that is stopping someone from the very left wing of the Labour Party getting a grip of things, who does not have as sort of godlike a view of the OBR and the fiscal rules as Reeves does. And I wonder whether markets are actually starting to look at the potential, what they would view as negative political fallout from the budget, more than do we balance the books or not. I think that's why you've seen this move in gilts.
Yeah, and I think that's half of the reason behind why she's rolled back on the income tax hikes, because that was a big manifesto pledge, and she's had a lot of grief from half of her party about that. All the hardliners. So yeah, she's got to balance the books, and she's got to balance her own party as well. But we could have another 3-hour conversation about this next week, I assume.
Well, I'm sure we will, because it will be in the run-up to budget day next week. In the meantime, let's get over to Japan. Is the risk of yen intervention rising, Ryan?
Oh, here we go. I haven't even got my yellow cards ready. I'm going to dig them up. I'll get Kireka to edit one in. Yes, but we might be seeing a new kind of intervention coming. Because one thing that's been abundantly clear since the new administration has come in is that a weak yen is not going to be tolerated. Now, we know all governments are not going to tolerate a weak yen, but it's been stark, the comments that we've started to get already from the new finance minister, Katayama, and other officials in the government. They've been at a far higher DEFCON scale than past governments and what we're usually used to getting. Usually there's a bit of a build-up. They go from we're watching FX markets to we're closely monitoring to now we're seeing rapid moves, from one-sided moves to a high sense of urgency. And then that puts us, right into the intervention territory. Now, granted, we've done over 800 pips in dollar yen since the start of October, 500 odd since Takaichi won the election. But that was really pretty much to be expected if she did win, given the market's so fiscally dovish view of the new PM. Now, since she's come in, there's been no real hint of any really huge bazookas, though we did start getting some numbers late on Friday and over the weekend, maybe around 20 trillion yen, which is fairly toppy, but it could be much higher, it could be much worse. So she's also mentioned previously that these measures are going to be targeted and they're going to be responsible. So it's not going to be, as I say, big bazookas and just lobby money all over the place. They're going to make it specific. So in the last 3 to 4 weeks, dollar yen has traded pretty tightly since then, 200 to 300 pip range. But that still hasn't stopped the finance minister from talking from that very high warning level, which means it might not take too much to get them picking up the phone to the BOJ and having them intervene. Now, right now, when you do the tick box on what leads up to intervention, we haven't got the volatility. But if you look at something like the BOJ's yen index, which I've got on the screen now, we are approaching levels where they intervened last year. So watch this index and dollar yen. If we get a big volatile move through, say, 155 and it shoots up to 156, 157 really quickly, we'll be massively in the intervention zone, and then you've got to be careful. So we're in a hot stage at the moment. We're not quite there yet, but it's not going to take much to push us out, I don't think.
No, I think I'd agree with you on that one. And it's a little bit odd, as you say, because they do seem a lot more sensitive to yen moves than we have seen other administrations. The other issue or difficulty that they're going to have is that the Ministry of Finance and the Takaichi administration, they do appear to be sort of running an economic policy akin to having their cake and eating it, whereby they want to unleash this sort of huge fiscal bazooka on the Japanese economy. They want to ask the BOJ or lean on the BOJ to, well, not necessarily keep rates low, but certainly tighten at a very, very slow and sluggish pace. And at the same time, they're running around telling everyone that they don't want the yen to weaken much further. Well, I'm sorry, that's not a particularly sustainable policy mix, even if you were to intervene, unless and until one of those three sort of pillars were to change substantially, then it's tough to imagine the sort of overall direction of travel changing particularly much. But I do think you're absolutely right in flagging that this administration's sensitivity to moves in the yen is much, much more heightened compared to what we've seen from other Japanese administrations recently. And as a result of that, even if conditions were to settle down a little bit, the risk of intervention is starting from a much, much higher baseline than we have. Well, you watch things much more closely than I do in terms of Japan, but certainly than I can remember in a number of years.
Yeah, absolutely. And as I say, we always go through the checklist, so you always get an idea of what stage they're at, and they are at a much higher level. And then you've got to think, particularly with the BOJ, unless they're going to get into a hike cycle and they're going to take rates to 2% or something, any strength in the end that we get through the BOJ is probably not going to last, because it's going to get overrun by whatever's happening fiscally. So yeah, I'm a bit unsure. I don't want to see one of these situations with the yen, particularly if it just keeps slowly grinding higher, and you don't get a dip and it doesn't retrace, and then you can't buy it because of the intervention worry or caution, and then you can't sell dollar yen on the back of intervention because it can go and grind against you for another 300 pips. So it can become very difficult to trade this one. I'm actually a bit neutral at the moment, just going to sit on my hands regarding trading that until the picture becomes a bit clearer.
Yeah, of course. The other thing with the intervention, not that I would ever advise anything, but certainly wouldn't advise trading it from the short side, is these moves happen so quickly that it's very much blink and you miss it. Dollar yen can print 157 and then 5 minutes later we're printing 153 and you've missed the entire move and you sell the bottom out of the market. So yeah, very much a case of needing to be nimble and agile and watching how things progress. Anyway, let's get on to our plays of the day. Right, I'll make this relatively short and sweet. Looking at cable, of course, just rewind about 5 minutes and you'll find out the reasons for being bearish on the pound and just generally everything UK related at this moment in time. It feels like a bit of a question of when rather than if the bears pounce on the pound at this point. And I'm happy to wait and then move with them when they do. This sort of 131.40 region, which marked the lows a couple of times earlier this year, is proving notable support for the time being. But if we were to get below that, then you'd immediately be looking for a move back towards the 130 figure, which we did actually hold earlier in the month, surprisingly so. But if we were to get a break below, then you're looking into the 127s in relatively short order. I would be happy to be proved wrong if we were to get a move back above the 200-day moving average, but I really can't see that happening anytime soon. And I think the broader point here is, the classic sign of the market being worried about fiscal credibility is if and when we see the pound and gilts beginning to trade in opposite directions. If we see a yield up, currency down scenario, then that really does spell trouble for UK PLC. Ryan, we are going down under.
Yeah, I'm going to Aussie Kiwi. This was a pair I actually got burnt shorting into some of the multi-year highs and technical levels a few months ago in the 110, 112 area. We were in big breakout territory above the 38.2 fib of the 2011-2015 high to low move. So this is a pretty big break we're seeing, a multi-year break. Now, that level, that fib level, actually held on a dip after we came off from the highs in the 116.40s. So it's a bit of a significant level already as far as support is concerned. Now we've set that high and seen a decent retrace, there's a chance of seeing maybe a more solid top forming here. So I'm looking to see how a retest of the highs reacts. If I see a test 115.85 up to 116, that's that zone marked on the small picture there. If that holds firm, I'm going to look to short there, but I'm going to look at this trade in two ways. Firstly, I'm going to play some as a short-term trade, taking partial profits on dips back towards that 38.2. Then secondly, I'll look to build a more longer-term short to see if we move back into that 11-year range, maybe even back down to the 108 level. So any move above the highs, 116.40s, would probably confirm we're not done with the uptrend, and then I'll be heading to the exit door pretty quickly.
Good stuff. Viewers, please be rest assured that I will be having a word with Ryan about that abomination of a chart, and we shan't be seeing anything quite like that ever again. In any case.
Sometimes, I don't know. We're going to have a vote one day. Who's got the best charts?
Well, Yeah, it'd be like your sweepstakes, rigged, but in my
Oh.
favour this time. Anyway, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you, as always, as well, to our producer, Kyriakos, for bringing things together as brilliantly as usual. Hopefully, you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know your thoughts on the markets right now, if there's anything you'd like us to discuss next week. And that is when we'll be back with another episode of The Trade-Off. In the meantime, have a great week ahead, and we'll see you in a week's time. Thanks for watching. Goodbye for now.